Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. As always, thank you for listening. This episode features Meb Faber, one of the coolest people that I have met in finance or other places. He is the CEO of Cambira Investments. He is the host of the Meb Faber Show, and I really respect how he goes about marketing his firm, educating people, putting out research, and I respect who Meb is as a person. So this conversation talks about the global market portfolio. We talk about foreign stocks. We talk about launching an ETF. He goes into his thoughts on marketing a firm. I encourage you all to check out the detailed show notes. There's going to be some links in there, and there's timestamps of the conversation. But overall, I think it's a great one. The episode is sponsored by Daloopa. Daloopa is founded by a former hedge fund analyst to bring simplicity into the investment process. Daloopa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. Daloopa scales the velocity of an investment team's idea generation. Analysts spend less time locating and manually inputting meaningful disclosures into Excel and more time synthesizing in the minutes after the print. Daloopa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Daloopa's data sheets include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Daloopa's Excel plugin can also update your existing models for the latest quarter in just a single click. Bulge bracket banks and major multi-managers are trusting Daloopa for use in initiating coverage, building and maintaining industry dashboards, and keeping their models up to date. Visit daloopa.com, that's DALOOPA.com/business brew to create a free account and learn more about how Daloopa can help increase your team's speed to differentiated insight. It's a great product. It's an institutional product. The auditable feature is extremely valuable. You can click on something that brings you exactly to the source that you are getting the information from. And I have found the Daloopa product to be very impressive. As always, none of this is financial advice. Nothing contained in this program is financial advice. All of it is for entertainment purposes only. Please do your own due diligence and consult a financial advisor before making investment decisions. All right, enjoy the show. Ladies and gentlemen, Meb Faber returns. How's it going, Meb?
Hey, buddy. What's going on?
Not a whole lot. Also a whole lot. So I pinged you. What did you want to say?
I said, out of curiosity, what podcast host records on Monday mornings? I was trying to think about this, and I was trying to think about like my lowest cognition of the week is probably right now, or maybe Friday night. I don't know. It depends on how you determine the cognition. But
yeah,
is this your set weekly record date?
No, I tried to be amenable to your schedule. And
you're like it's Monday. Meb's got nothing to do.
No, I gave you a bunch of different days, and you said Monday would be fine. But I did not anticipate that I'd be fresh off a Berkshire weekend.
How was it, man? I've only been once. I loved it. Give me the review.
It was very fun. I probably could have behaved myself a little bit better, but I got to meet a lot of the fans, which was super nice. I also now get to experience what you and Toby and others have gotten to experience for a long time. And there's not a lot of me time in that weekend. So that has been a new experience, but I'm super grateful to everybody that said hi. And I'm shocked that some of y'all listen, but thank you for doing it.
When you say behave yourself, does that mean you actually like went to the meeting with a giant whiteboard and it was like heckling? Cause like, they don't get any hecklers, do they? That'd be kind of funny.
Well, they used to get the people that I think during the proxy stuff, I think they get people that kind of grandstand. And I think that's why they didn't broadcast it this year.
Yeah.
I actually didn't even go to the meeting.
Yeah. That's
so
hilarious.
I watched it in my hotel room. I kind of think it's a little bit like a football game where I had a perfect view and I could hear everything that I wanted to. I did miss the movie, which I heard was interesting. Jamie Lee Curtis apparently had some sexual innuendo to Charlie, but what are you going to do? You're old men and you're rich and you got access to Jamie Lee Curtis. I guess you do stuff like that.
There was one of the most amazing statistics of the past few years. Chris Bloomstrand, who I'm sure was there, big Buffett fan, he had a tweet a few years ago, or maybe even a year ago. The years COVID, post-COVID, sort of just blending in at this point. But he said, you could go back to Berkshire's inception versus the S&P, and Berkshire could go down 99% and still be outperforming the S&P. And I said, there is no way that's true. And, so of course I pulled my Excel sheet and sure enough, it was true. And I tweeted to him and he said he once told that to Warren and Warren's response was, Ben Graham would be proud, but let's not test the math. But it's amazing statistic. It sounds totally false. It sounds like something you would see on the fake news, Twitter, and then just be like, that can't be true.
Yeah, it's impressive. Whether or not it will be impressive going forward is sort of the relevant question, right? But it's a hell of a career, and I love getting together with everybody. It's my favorite networking event of the year by far.
I like to invoke Buffett a lot when people are chasing performance or talking about what's going on this month, this quarter, this year. As we all know, individuals, but professionals are awful at kind of trying to draw inferences. There's another quote we like from French Fama where he's like, people are crazy when they try to draw inferences from 3, 5, or even 10 years of active managers or asset classes. I mean, think about that, 10 years. But we like to draw the Buffett example, of the performance outperformance on, going back a certain amount of time and looking at how many years and periods he's just sort of mediocre or has been okay. And then these certain periods of just massive exponential outperformance. And that's kind of true with a lot of active managers and strategies and everything else. So anyway.
Yeah, I think the thing that I took away, interesting coming out of a bear market, but is, you try to stay in the game and then make the right decisions today. And if you make a few good ones in your lifetime and you stay in the game, that should, end up satisfactory. One of the things that I have recently been spending a lot of time on, and is one of the reasons that I pinged you, is you are the man for the global diversification message. And I can't help but look at where the US is in the last 10 years and kind of wonder if now isn't a great time to be really considering some global diversification. So, we'll see how it all works out. But I'd be curious to hear your thoughts. I see your tweets on, the global portfolio ex-US outperforms. And I think it's something that so few people are thinking about given the last decade that, I don't know, wanted to have the conversation. Plus your podcast is absolutely killing it. I wanted to say that publicly, but we'll get into that.
Well, but like when you're spending your time thinking about this, and it's funny because we actually did, the last time we chatted would have been Halloween time, 2021. And we talked a little bit about global then. But
which I think has outperformed since, right?
Yeah. What's been, and the majority of that I think has come in the last few months, but what's your worldview? Like, are you entirely US focused? Is it only Florida stocks? Like what's the
Yeah. I like to take home country bias to hometown bias as much as possible. No, man. I mean, look, my grandma passed away recently, and it's going to force me to change a decent amount of my allocate, like just by nature of that, some of my allocation will change. And it's like, okay, well, I'm clearly overweight US, and I can get myself to say, well, the revenues are diversified, but I think it would be impossible to say that the multiples are not correlated to the US stock market. And, I'm trying to, I mean, when we had beers in Manhattan Beach, we were talking about like being anti-fragile, and it's a different level of responsibility that I think that I'm assuming now, and I'm not as concerned with return optimization as I am with making sure I make it to the end of the game. And I've been listening to Dalio's Changing World Order book, and people can think what they want about it, but I think there's some probability he's correct. And if that probability is out there, I'd rather not go through a massive drawdown in a negative scenario in my own country. So that's kind of where I'm coming at the whole thing from.
Yeah. I think one of the quotes that resonates a lot with me, particularly as I get older, but, as an investor, an entrepreneur, but is that, the biggest compliment you can give anyone is that they survived, right? So, hey, you're a startup, 90% fail. Whether or not you're a unicorn, $100 billion company, whatever, the fact you're still around is already, you've done more than 90%. As an investor, I mean, how many of our friends, family members have you seen over the years that have just impaled themselves and gotten taken out of the game, right? Everyone's searching for the alpha, for the outperformance, for, optimizing on Cager, but often it's at the expense of getting taken out. And so thinking about that, I spend so much time looking at history, and there's times where, even the past couple of years, let's look what's happened. Russia, for all intents and purposes, is uninvestable now. It's like frozen in the Han Solo sort of kryptonite, but it's not a zero, and we could actually get deeper on that because there's some interesting ideas there we can come back to. But for intents and purposes, if you look back to history, 1900, that happened in 1917 in Russia, revolution. It happened in 1940s in China. And as you look at the arc of history, there's been plenty of instances where countries, and you can just go down the list, any of them, have a massive drawdown in their markets. So 80, 90% or 100 essentially. And so these little 50%ers we've had in the past decade, they're painful. People pull their hair out, global financial crisis, and all the terrible things that happened, and the internet bust for, all the Bay Area, the internet winter. It gets like exponentially worse. Apparently amazingly, we had a little earthquake this morning in LA, which I didn't feel. But the last time you and I did a podcast, we had an earthquake in LA.
Huh. Okay. So, well, we may not do any more podcasts, but thankfully you're okay.
Yeah. And so these 50%, to me, drawdowns are like a Ricther scale. And I think it gets exponentially worse at 20. 0 to 20, I think people don't care. 20, people start freaking out. And then it gets Ricther scale, 10x. Every 10% down, you go from there. So it gets way worse, 30, 40, 50. And after 50, everyone's like losing their mind.
Yeah, that's a lot of paper wealth to watch go away. A lot.
And so speaking of Dalio, Bridgewater actually has a great piece, and we can put it in your show notes or wherever, where they looked at drawdowns of every equity market and basically demonstrated that when each of those equity markets had their drawdown, you would have been better off in an equal weight portfolio of countries. And so you have this period. So by the way, you should pat yourself on the back. You should be very happy that you've been U.S. focused. And if anyone's listening to this, everyone's U.S. focused from the U.S. that's listening to this. Congratulations. Like, that's been amazing for the past decade.
Yeah, it's been an insane run, right? But then you got to ask yourself, what's next?
So this Bridgewater piece that I was talking about, U.S. outperformed in the 2010s by a mile. They also outperformed in the 1990s, right? You remember that? That was like my favorite bubble, run up, bull market. Before that, it was 1910. So not just outperformed over the period, they underperformed equal weight of countries every decade going back to 1910. So what is that, 70 years? You would have been better off in an equal weight portfolio. And that's on return. So, it's people get so myopically focused on just like short periods. And when I say short periods, I mean like a decade or 15 years, not like 1 or 2 months. So it's hard, but I think when we look back at the arc of history, when you and I are doing this in 2033, I think we'll mark last year probably as the inflection point. That's my guess. The US dollar peaking in Q4 of 2022. And I think the value trade actually, the inflection point would have been when we talked last time. So every time you and I talk, there'll be like an inflection point. 2020, 2021 was the value growth inflection, all the craziness we saw with the meme stocks, SPACs, all that crazy behavior, but also the interest rate bottom and inflation bottom really in those 2 years. And I think it's been a different environment for arguably probably, I think, the better part of the next decade.
Yeah. I don't know what, like, I'm certain I don't know what's going to come. And I guess that's why I've got myself thinking more and more to what you have preached for years and what you preached when we talked for the first time. But I just kind of, I guess I'm just, to your point on making it to the end, I'm just looking around and thinking about what lessons have I learned that are probably wrong. And I pinged you because I think you have a message that's worth listening to. I mean, you've been on a kick lately. It seems like every time I see your Twitter feed, you're posting a statistic. Like the one that got me really thinking was you had the two portfolios and you were like, these portfolios are objectively, like B is objectively better, right? Because it's got lower drawdowns, but they have the same returns. And then you said, but this is all stocks ex-US. And then people like freak out when they hear that. But, you show the numbers, you can't argue. And then you tell people what it is. And they're like, that can't be so. Oh, maybe it's so.
Kind of like Chris's tweet earlier on Buffett outperforming. I think the Pepsi Coke taste test is a great way to think about a lot of these things because it takes away your bias. And we used to talk about this with buy and hold and trend following because people are really averse to trend type of strategies. We can always come back to that. But let's stay on US and foreign for a minute. But the single number one most held investing belief of everyone I know, professionals, retail alike, is that US stocks are the game in town, right? That's the starting point for everyone. That's the majority of everyone's portfolio. I don't know a single person that is an investor that doesn't own US stocks. I do not know a single one. And the only exception would be like, a retiree who just owns some muni bonds. For the most part, anyone who is putting money to risk owns US stocks. And so I like to, frame things differently. And I said, well, let's come to this. And so everyone assumes you have to own US. So US is a percentage of market cap, 60%. The average US investor is up over 80% now. And some of the highest percentage of all time on US stocks is a percentage of their net worth. Of stocks, it's 80% plus. And this goes back to one of my favorite charts that has one of the best future forecasts of U.S. stock market performance, which is percent of your portfolio in U.S. stocks. And this is old Jesse Livermore. And I'll give you a link to it for show notes. But it has an amazing correlation with future 10-year returns. And, it's been as low as like 10%, and then it gets up into 50%. The St. Louis Fred database has it too. But it's all capturing the same thing, by the way. It's capturing price, it's capturing sentiment, it's capturing allocation. It all moves together, right? And so, but I said, let's everyone owns all their portfolio in US stocks, even if they own 60-40, because stocks are more volatile. It's essentially all US stock beta, right? The exposure, as we saw last year when the 60-40 got creamed. So, but I was like, let's do something fun. Let's start with the premise you can own US stocks. Can you still succeed as an investor? And so very simply, and this is a post we did called What If You Owned No US Stocks? And so it took me about 10 minutes to do this, but I came up with an allocation of, it was, let's see, REITs, foreign stocks, corporate bonds, US foreign bonds, gold, that essentially exactly pegged US stock return for the last 50 years. So 10.2%. Around 15% volatility, same Sharpe ratio, same Sortino, same drawdown, same positive months. They took a different path to get there. They zig and zag a little bit. But the point is there's so many paths to wealth. I mean, the way that most Americans do it is through real estate. They buy a house, which my take on that is always that it's not actually the house appreciation that's so magical. It's just they were forced to save.
Yeah. I agree with that.
Money they would otherwise spend. But
and it helps that interest rates went down for the last 40 years, right?
But so then you can say you demonstrated you don't have to own U.S. stocks, okay? And so then I said, I want to show a couple other examples. And I said, what if you just invest in the global market portfolio? I drone on about the global market portfolio a lot because it's a great benchmark of a global investment portfolio. And that's roughly, if you bought every public asset in the world. So it's roughly half U.S. today, half foreign, half bonds, and half foreign bonds, actually, which no one owns. But it's been a great portfolio over time. And then I say, what if you just remove the U.S. stock component and replace it with all foreign stocks? And again, it's almost near identical. I think if you go back to the 70s, you lose about 20 basis points of return. The lines are indistinguishable. You can't even tell the difference on a chart of the two lines. And then you take it back all the way to the 1920s, and same thing. It's a slight difference, but it's a huge bias because that U.S. stocks outperform most countries. Now, they didn't outperform all countries, which is always my rebuttal to when people are like, well, yeah, Meb, but U.S. stocks crush foreign stocks. So I say, that's why you put all your money in U.S. stocks? And they say, well, yeah. I say, well, Australia beat the U.S. Does that mean you should now take all your money and put it in Australia? They're like, well, no, that's crazy. That's why is that crazy? What about South Africa? They beat the U.S. Do you feel comfortable putting all your money in South Africa? No. So start from the premise, which no one will believe or listening to this, that you don't have to own them. You could do fine without them. But then also you can no one's going to do that, but talk about all the reasons why it makes more sense. But the biggest one you touched on in the beginning is you remove the outlier risk of something happening, whatever that may be. And I could come up with a list of 10 things pretty quickly that, could demonstrate the U.S. underperformance, valuation being the most obvious, but macro type of ideas. Like what if, for example, the next, Sergey or the next Steve Jobs is hanging out in India right now, or China, or Singapore, or Colombia, and they make an AI innovation that's 10x better than OpenAI currently. And all of a sudden, let's just use India. All of a sudden, India has this renaissance of companies, and they're not sharing it, right? All of a sudden, it's transforming medicine and logistics and mining, on and on. And all of a sudden, India becomes a global superpower. That's not that improbable of a scenario, right? And the U.S. kind of fades away into obscurity, kind of like, I don't know, the U.K. Has been in the news a lot today. At the beginning of 1900, they were the largest market cap country, 25%, way bigger than the U.S. And what are they now today? 3? I don't know, rounding error.
Yeah. The UK and how it disappeared. I don't know what you get out of your podcast, but one of the things that I get is the ability to have conversations with a lot of different people. And the UK has been coming up a lot as a market that people just don't want to hear about. Japan has been coming up as a market that people, somebody was telling me this weekend, somebody said, oh yeah, everybody goes through a Japan phase and then inevitably loses money. But now there's apparently some real directives from the government that, I need to look into, but it sounds like they're taking corporate governance very seriously and understand shareholder return. And, if you think about the idea that equity returns can be juiced by leverage and margin expansion and turns and whatnot. I mean, I just don't know how much more juice we have to squeeze out of the current whatever fruit. I'm trying to take this analogy where it needs to go versus what they have, right? And they're starting at lower valuations. It's just a thought.
Here's the thing about Japan, because all of FinTwit loves to joke about Japan and always kind of say, well, that's, the outlier. Everyone loves to bring up Japan, but there's a reason for that. And, Japan listeners, for the gray hairs or no hairs listening to this that were around in the 80s, I mean, Japan was taking over the world. Japan, all their companies were crushing U.S. companies. Their stock market, their real estate market. Everything was all Japan all the time. And it culminated in the most expensive stock market we've ever seen. Now, rewind, by the way. So as we look at foreign investments, back, and they were the largest component of ex-US, but of the globe, they were 40% of world market cap. So US is 60 now, Japan was 40. So they were bigger than the US by quite a bit. And they hit a long-term PE ratio of almost 100. So US, for perspective, US during the internet bubble hit a peak of 45. This last cycle, a year or two ago, it hit 40. It's right around 30 now, so still quite expensive. But on average, countries are around 18. In low inflation, it's around 22. And if you look at a chart, and we'll send you one of global 10-year PE ratios, US and ex-US, it's almost a perfect mirror image of the 1980s, right? So you had in the 80s foreign stocks going moonshot. So you had the long-term PE ratio getting to be in the 30s. I think it hit a peak of around 40. So same as this cycle, same as the US in the late 90s. The US was smoking cheap, low teens. And then as the Japan bubble deflated and the US ascended for the 90s, you had it switch, and then they kind of zigzagged for a little bit. But then starting in 2009, it's a massive alligator jaws of US going up and foreign going down. And so, people love to joke about that example, but we could be sitting here in 20 years, again, maybe on a hologram or whatever we're doing, and joking about these podcasts we used to do that was sort of the inception of sort of this ex-US outperformance. You could easily see that happen. Not sure always exact. People always love to talk about catalysts, but so for perspective, US is at 30 PE, foreign developed is, let's call it teens, high teens. Foreign emerging is low teens, and that's really cheap stuff. Japan specifically, I can pull this up while we're talking and see what their actual long-term PE is. But plenty of countries are in the single digits. So Japan's at 19, totally reasonable, but that's after a long period. Japan's the number one holding in our foreign developed shareholder yield strategy. So we're and that's quantitative. So we're clearly finding a lot of opportunity there.
How does shareholder yield work? How's that constructed?
I was telling you this in the preview, but we're actually, I'm not sure when this comes out, but we hit a 10-year track record on May 15th, which is
Congrats.
Crazy. Thanks, man. And shareholder yield is, if we teleport it back in the time machine 10 years, it wasn't a concept we invented, but it was a concept that we try to only launch funds that don't exist. So we have 12 funds, a bunch more coming. And there weren't any shareholder yield funds, and there still really isn't. There's hundreds of dividend funds or funds of that strategy. But we kind of scratched our head and said, look, this is a topic that's been around for a long time. The academic literature supports this concept, and listeners, at its very core, the main muscle movement is there was a structural change in markets, but it's been around forever, but even more so in the 80s and 90s in the US, where companies started buying back more stock. And so if you look at the 5 ways only 5 things a company can do with its money. It can reinvest in the business, the sexy part, right? It can launch new iPhones, it can do R&D, it can pay down debt if it has it. It can go acquire other companies. And then the last 2 is just return that cash to shareholders, which, by the way, in Omaha, they talk about more than anyone on the planet, dividends and buybacks, right? And it was funny because a big news story came out and said, secret to Berkshire's success is dividends. And I was like, wait, hold on, what? Buffett famously is like on Berkshire never paying a dividend. He said they actually paid it in the early days once, he says it's because he was in the bathroom when they decided it. But shareholder yield at its core is this concept of looking for cash flows on net cash dividends plus net stock buybacks. And why that's important is since the 90s, U.S. companies in particular pay out more in dividends in buybacks every year than they do in dividends. And so if you're a dividend-focused investor, you're ignoring an entire over 50% of how companies distribute their cash. Also, equally as important of this cycle, you're ignoring companies that are issuing shares. So I saw a stat like 2 years ago, that said it was like 20% of tech sector revenue was due to stock-based compensation. So all these companies just giving shares to management. If they were giving it to all the employees, that'd be one thing. I'd be more sympathetic to that. But if they're just issuing a ton of shares, has a huge dilutive effect on the stock price. And so accounting for both sides of those, it's like being a value investor. Everyone focused on the cheap stuff. But as we've seen in the last couple of years, it's equally important to avoid the stupid expensive, right? And so you get an index, you get both. But shareholder yield is saying, all right, we want companies that are trading, that are distributing high shareholder yield. So on average in the funds we manage, we have a US, a foreign, and emerging. And for listeners, just to demonstrate my bias or lack thereof, maybe, I don't know, our largest fund by a factor of 5 is a US stock fund. So I'm directly not talking my book, but I do think that the value trade in the US is one of the biggest opportunities as well. It's just anything but market cap. Anyway, shareholder yield, a ton of academic practitioner support for the idea. But it's been weird that, I don't know if it's weird or not. Like I look back 10 years and I say, okay, our strategies have done great. Why hasn't Vanguard launched one? Why hasn't iShares and State Street? And so part of me is happy they haven't. I say, okay, we don't really have any competitors. And the other half of me is saying, are we just crazy? You know, why does it? Because once you take and this analogy is overused, but once you take the pill of looking at a company and a stock through this shareholder yield lens, you can't go back. And a good example would be, Apple, which we held for like 8 years. It wouldn't show up on any of the dividend or buyback screens because it did both. It did half in each, right? And so there's even companies that people will screen for and say, it's got a 4% dividend yield, amazing. But they issue 5% a year in shares. It actually has a negative yield. Many or most companies have a negative yield on the buyback side. So it's crazy to me that people don't adopt this idea, but who knows?
I was doing some math on Google's repurchases, and when you figure what they've given out and what they've repurchased, they're paying like, I think the number was like 140 something a share if you look at the net, and then you look at where the stock trades, and obviously it's not all wasted. Some of the dollars are spent at or below intrinsic value, but there's some above. So I would think that netting it out across the universe, probably, I guess the risk in any single instance is that you're probably like, there's probably some element of pro-cyclicality in the buybacks, but once you diversify that out, it probably works. So, and you're doing this globally.
Yeah. So we have 3 funds. One's US, one's foreign developed, one's emerging. There's a slight cultural difference in the foreign funds versus the US. The foreign funds tend to still have a cultural history of preferring dividends. That's changing. Japan is a perfect example. We're seeing a ton of companies that are doing a lot more buybacks than dividends. And on all 3, you're essentially looking for low teens shareholder yield, right? Which is a pretty astonishing number. Now, what's important, and we use this as a part of I think you're fine in shareholder yield alone, but our process also uses a valuation composite. So we take a handful of basic, very simple valuation metrics you would know and love, kind of use an ensemble approach, and want to make sure these companies that have a high shareholder yield are also, the stock is very cheap. Now, one of the biggest misconceptions, and there's very many about buybacks, and we did a post called FAQ on buybacks for investors, gurus, lawmakers, because I promised myself I wouldn't talk about buybacks anymore on Twitter about 5 years ago, and the politicians just keep getting dumber and dumber. And the discourse about it is just so talk about fake news. Anyway, so we have an amazing resource of about 20 pieces from all walks, academia, journalists, investors, about buybacks, because the same comments get repeated over and over and over that are simply been proved to be false or untrue. Buybacks used to be illegal. That's not true. Actually, companies and governments and investors used to require, about 100 years ago, that companies had to pay out dividends or buybacks, because guess what? The CEOs were squandering the money. And so I was laughing, like Elizabeth Warren was talking about this like a year or two ago. All these people want to make buybacks illegal. And I go, talk about all-time unintended consequences, which is, you know what? You want to make executive compensation higher. You want to start seeing more stadiums get named. You want to see people buying more jets.
Give them more cash,
give them more money.
Yeah.
And so what they're all trying to get at and what they're missing is they're trying to get at executive pay, which is a board issue, right? And executive compensation. Buybacks are the exhaust. That happens all the way down. And so what they're looking at is like, no, they gave all these CEOs a ton of shares. Right. That's the issue. It's not that they're trying to hide it with buybacks. Okay. Well, they could also just not do buybacks and still no one's going to pay attention anyway. So you hit a funny bone for me. So this topic we could spend hours on, but there's a lot of misconception. It used to be illegal. They're doing it just to juice EPS. All these things just like wrong. But once you see the world in this light as an investor, it's really hard, if not impossible, to go back thinking about how to invest without incorporating that information. Because to me, and even Munger, I mean, there's a ton of Munger and Buffett quotes about this topic. He says, look for the cannibals, the ones eating themselves on a share count. So it's hard to, I think, see the world any differently after the fact.
Okay, so when you think of releasing an ETF, like I heard you talking to Sam Zell, which was great, by the way, and then I heard you came in and you plugged the Cambria REIT. Like how are you, or the real estate ETF that you have? How do you think about releasing these products? I mean, you said we want to go where no one else is, but what's that process look like?
There's kind of four things we think about. And for the listeners out there, if you want to launch an ETF, don't call me. Call Wes Gray or Mike Venuto. Wes is at ETF Architects, Mike Venuto at Title. These are the two big white label businesses. They've helped billions of new issuers as well as mutual funds. But I think everyone should launch an ETF. I think there's about 10 use cases that make so much sense. And it is our belief, and I'm biased as a CEO of an ETF company, and that's Cambria, that ETFs are eating the traditional high fee, tax inefficient world. And I had a prediction in Barron's years ago where I said ETFs are going to cross mutual fund assets. Everyone laughed at me. And I thought that just the world would see that it's a better structure. It's much more tax efficient for taxable investors. We estimate it's about a 70 basis point difference between ETF versus active mutual fund. And if you look at last year, by the way, listeners, some of you, this may be too painful, probably still a lot of PTSD. There were mutual funds out there that were down 20, 30, 40% last year that paid out a 10, 20, 30% capital gain distribution. And ETFs don't do that. So anyway, they're not always the best structure. Like if you're doing a catastrophe bond fund, it's not going to help. But we try to do four things. The starting point of this discussion to me is realizing what the world looks like, which is it's the best time ever to be an investor. But like if you go down to the local grocery store and there's 700 types of cereal, it's also somewhat hard. There's tens of thousands of funds out there, which makes it very difficult to sort of curate what's even being launched or what's out there. You can buy a Vanguard or similar portfolio for almost 0%. That's amazing, right? If you think about all the costs of when we grew up and our parents, my uncle worked for Dean Witter, and you look at the commission schedule, like it was crazy. And now it's essentially zero. It's actually probably negative, including short lending. Best time ever to be an investor. So if you're going to charge more than that for a global market portfolio of market cap weight, you better be doing something either weird, concentrated, or different. And so we try to exist in this very dark corner where we're not going to have any competitors, right? Or try to only, so first thing is we try to launch funds that either don't exist at all, or we think we do much better, quote, or much cheaper. And cheaper is hard these days with the big Death Star Vanguard, but there's a number of our funds are the cheapest in the category. We have the cheapest fund in the tactical category. We have one of the cheapest funds in the asset allocation category. And I think all of our funds are cheaper in the category average. So we try to launch funds that are only supported by academic practitioner research. We often do that research. We try to launch funds that I want to put my own money into. So it's not like a lot of the big guys are throwing these crazy spaghetti against the wall, see what sticks, chasing whatever the trendy trend of the day is, disruption. I don't know what it is this year, probably T-bills, probably money market ideas. And then there's anything anybody actually wants. And that for me is a hard part, because there's a lot of ideas we have that are probably just not very marketable. And of the 12 funds we've done, some have not scaled as much as we thought. Like we did a buy and hold asset allocation global portfolio with tilts towards value and momentum, trying to disrupt the entire asset management industry. And I think it's the second cheapest ETF in the category. At the time, I think it was the cheapest. And it's done great. And it's at like $50 million, right? Meanwhile, there's like, I think 500 billion to $1 trillion of asset allocation funds that still charge 50, 100 basis points, 1.5%, 2%, right? So it's inevitable, I think, that we'll win that. And we being other firms like us, because if you look at the sort of alligator jaws of fees, it's all moving. And the media always says active versus passive, but it's really just really high fee legacy to in conflicts to low fee type of investments. Hasn't happened yet though. So we'll see when.
Why do you think that ETF has not scaled as well? I mean, it's just what resonates with people. Is it that simple?
I think we're pretty bad at marketing and advertising in the traditional sense. We built our firm largely based on research. So early days was academic papers, books, and blog. Now more modern, that's podcasts and, maybe YouTube. We'll see. TikTok, holograms.
Podcast is tough though, because you can't like get on and talk about your own products, right, on your own podcast. Isn't that factual, or do I have that wrong?
You have to be thoughtful. You have to be accurate. I was, you probably saw me losing my mind on Twitter the other night because we've written about or published 3 investment companies that were frauds, and two are gone now. One that we did on Twitter in real time. It was kind of fun. I was like, 99%, this ad I saw on Instagram, this is a fraud. And a week later, it got shut down in Texas. It was a $250 million fraud. Now, the bad news is I didn't do a whistleblower, so I got none of the proceeds. There was a $270 million whistleblower last week, by the way, reward. And the 2 that I've actually sent to the SEC, I'm like, look, these guys, they're doing bad things. They declined to pursue. So I said, my podium is just Twitter. I'm just going to tweet these out. And then I made the accident, or it could be good in retrospect. I was talking about Ty Lopez's last summer, where he was guaranteeing 20% dividends. And I was like, oh my God, you can't be saying this. And then I hit a like on Instagram, and now all I get is targeted investment scams that it's like 50% IRR, 50% AAR, whatever that is. I know what ARR is. And then it's just, and so I just tweeted all of them. And this was just in one night, and there's like 15. So if you're an aspiring, enterprising young analyst listening to this who's broke, go get my Twitter feed, go submit them all to the SEC whistleblower and collect millions of dollars. And you can just thank me in a love letter. But the one benefit of podcast, Bill, that we used to do, which you should do, is we say, you like this podcast, you can send us a GIF. We used to do this years ago. We don't do it really anymore. And it was like on the weekly, we would get stuff showing up the office. It would be like lox salmon from Canada, we get some tequila. So they can say, just send me something in the mail. It usually ended up being a lot of food. But yes, you can't. But I think there's a ton of SEC regulations. There's a ton of FINRA. There's a ton of Morningstar, on and on. But I think at the very core is if you're accurate, reasonable, and follow the rules, like you're going to be okay.
Yeah. Well, that's how it should be.
It's the people out there that are just saying, you know what, GDP is going to be 50%, and we think our fund performance is going to be 50% for 5 years. And we know who we're talking about here. And it just triggers me.
Yet they're
to no
still
end.
out there, man.
Oh, no, yeah, still out there. They're like a $30 billion shop or what, $20 billion shop, whatever it is.
Yeah, it's crazy.
So, but
how does it happen? Well, we don't need to have this conversation. You don't need any heat on you, but I don't understand how that happens. And it's in broad daylight, and the SEC doesn't do anything about it. It's like, what are you talking about here?
Yeah, I mean, look, the good news is, I think you and I know this. I don't think of an instance ever where grandstanding and chest beating and lack of humility has been rewarded in investing markets. ever, right? We have a ton of scars. We now do a regular feature on our company. We try to email one of these about once a year, once every 2 years. Everyone's always, if I was a better marketer, so we're at about 2 billion now, 140,000 investors. And if I was better at my job, I think we'd probably be at 10 billion, because if you market or talk about the areas where you're crushing it, you can raise money. So we've seen this over time where investors chase performance.
Yeah, but you care about the investors, so you don't do that. You highlight the funds that are probably underperforming, and then people are like, I can't chase that.
We wrote one piece called Totally Not Crushing It, and we were trying to...
I like that piece. I read that piece.
It was great. Well, so we now do it like once a year. And so a couple years ago, it was a long, short, hedged sort of value strategy that's tactical, called Value and Momentum. We just did one I think it was last fall, and hopefully this is timely, on by far our worst, I think it's our worst performing strategy. It's a global deep value strategy. So on both times, I'm crossing my fingers we timed it okay. But basically being like, this is done very poorly. Is the strategy broken? Is something wrong? Has something changed in the macro? Or is it just simply something we believe in that's going through a rough patch? And try to be honest about it. And we'll see if it turns around. But I think, I think Cliff's done a very good job of this at AQR over the cycle, as he was talking about very publicly how many of his strategies struggled through sort of the meme stock mania. And then he came out the other end having sort of a record year last year. But I think being honest and transparent versus, so many people have outed themselves as being, kind of total charlatans. I can't ever say it right, over the number of years. And I just don't think those survive. Like, I don't think that's a sustainable business model to have.
Yeah, definitely not. But it's easier to milk in the short term, I guess.
Yeah.
You're a reasonably good marketer. You should give yourself some credit. 2 billion's nothing to sneeze at.
We've had no sales team for the vast majority of our existence. We started hiring some. And by sales, I just wanted people that were more almost like investment consultants. We're like, hey, we can help you getting deep on these strategies. We want to be a resource on the quant side, investing side, if you want to talk about this stuff. We've always led with trying to lead with content and research and publish a lot. And so when you're talking about sort of what do we do when we think about launching funds, we try to put out a piece before we launch them. Because my nightmare is having investors in a fund that don't understand it, right? That to me, that's the most frustrating experience to have, because when expectations don't meet reality, you end up in the worst place. And we talk about this a lot, but we always say when we talk to investors and they complain about one of our funds, I was like, oh, that's nothing. It can get way worse than that. Like, that thing's only down 20%. Like, I can come up with a scenario where that thing goes down 50 or 80. If you look back sort of the arc of history. So it's never an easy game, but the future is always different, right? Like, you never know what's coming down the pike.
Yeah. I like that. Don't, if this hurts, don't get ready, because it can get way, way worse.
Well, I'm sure you've heard it, and we probably even said it on the last podcast, but I tell investors, we do a lot of tweets and a lot of polls. And I ask investors, do you have a written investing plan? Everyone says no. I say, do you establish your sell criteria for an investment when you initiate a position? And everyone says no. And, that's a huge problem. It's a huge problem because not only on the downside, everyone thinks of it, hey, it's bad because I invest in something that's going to go down. How am I going to deal with it? But it's also true on the upside. We talked last time about 10 baggers, 100 baggers, and every 100 bagger was once a double, right? And so how many of us, if you see a double, sell it immediately? Like, oh my God, I just doubled my money. I'm going to go on a vacation. I'm going to go buy a new timeshare, whatever it may be, go out to the club, pop some bottles. But unless you think ahead of time of like, why are you in this? That double was a potential 10 or 100 bagger. And so I think it's important to think through, and it doesn't have to be that complicated, but you could write down sort of like 4 main reasons on, how are you going to evaluate this? And are you going to rebalance? What's the criteria for selling? A lot of people, they just wing it. And then professionals too. I mean, we see this behavior with people buying our funds. They buy it, does well, they'll continue to hold or buy more. If it does poorly, they sell it. And that's usually the exact opposite value additive behavior over the long term, as we've seen 1,000 times over in the flow data.
Yeah, I was talking to two guys that are considering launching an ETF, and they're from two firms that are very widely and talked about and highly regarded. And their theory of the case was, I've seen how the sausage is made and people would not like to see it, right? So rules-based is going to go a lot further than even investing in these funds that, people love, which makes a lot of sense. I mean, I think, taking the human part out makes a ton of sense.
The one thing I'm going to tell all the listeners who want to launch an ETF is you need to plan. There's two ways to do it. The easiest way to do it, and if you have this scenario, God bless you, is to have a seed or pin-up demand that you know of where day one, 20, 50, 100 million is going into the fund. Because there's no dollars going out the door. It's going to cost about 200, 250 grand a year just to keep a fund open. So I'm not talking about office space, employees. That's just the fund math. And most people, what they do, we've seen many times, is they see a pot of gold at the end of the rainbow, and they assume in the first 2 years, money is going to flow in just from all over the place. And that's really rare. So you either have one where you have a giant seed, 20, 50, 100 million, or you're cannibalizing, which there's a lot of people that do that. They say, look, I got this hedge fund. I hate sending around this 100-page PPM. It's tax inefficient. I'm just going to convert it to an ETF and boom, here's 50 million. That's the easiest way to do it. But if you're going to do it where you have a great idea, you're confident that you think it's sustainable, you need to plan for a minimum of 5 years. And that's $1 million. Now, but again, and there's degrees of it. If 10 million is going in from day one or 20, and depending on what you charge, it may not be as much and the risk is reduced, but they're not willing to give it a long enough of a time horizon. And I was tweeting about this, and this kind of circular from what we were talking about at the beginning. We published a book, I think it was in 2014, called Global Asset Allocation, looked at all the famous asset allocation models and said, almost every investment advisor out there is doing some asset allocation model. And they often do some in global, not much, but they'll put some in foreign, some in emerging, some in real assets like REITs, commodities. And we looked for the last 100 years on these asset allocation portfolios. So risk parity, endowment style, permanent portfolios, 60-40, Buffett, all these. And they all kind of end up in the same place. They zig and zag till they get there. But this period since 2008 has been the single worst period for asset allocation portfolios relative to the S&P in history, right? There was 10 years in a row, the global market portfolio, not over the 10-year period, 10 years in a row, the global market portfolio underperformed the S&P. The endowment style portfolio, which is the best performing portfolio in the book, underperformed for 12 years in a row. And let that sink in for a second. 12 years in a row, you underperform. And so the point being is that when you launch an ETF, it doesn't have to be an asset allocation portfolio, but the ability to launch something and for it to underperform, to withstand that. I mean, if you look at our shareholder yield fund strategy, it went years of being totally fine. I mean, it's a value style strategy. It tilts a little bit towards, it's cap agnostic, but it ends up probably mid-cappy, small cappy. And for the better part of the period, S&P just creamed everything. And so you have to be able to sustain these periods. And I think it's a lot longer than people think. Now on the inside, this strategy ended up doing phenomenal over the past few years. But how many people are willing to withstand that? And as you think about launching a strategy, whether it's tactical foreign bonds or long short REITs or whatever it may be, most people expect or hope maybe they get lucky a lot quicker and are not willing to commit to as long as it probably takes. As sad as that sounds for most.
Yeah, that makes sense.
Unless you got a high frequency, super active ARB strategy, then that's a different story.
Yeah. Gabelli is launching a bunch of ETFs, and he was talking about the tax advantages. And he's like, look, what am I going to do, right? Like the mutual funds, they're disadvantaged from a tax standpoint.
So going back to the Barron's conversation, when I said ETFs are going to cross mutual funds eventually, what I did not foresee, which is happening, is the ETF to mutual fund to ETF conversions. So I just thought people would launch ETFs, they would grow, people would sell the mutual funds. But the reality of how our world works is money just kind of, inertia is a big deal. It just sits there until something happens. So death, divorce, giant bear markets. And this is what a lot of the giant asset managers, I think, are counting on, or people later in their careers. They're like, dude, I'm not going to go disrupt my entire business. I'm just going to, hold on to my 2% fees and just like into the sunset, watch this business just kind of land or go out of business. But the conversions that are happening now are DFA did like 50 billion in conversions. And so now, if you're the government, the correct thing to do is just equalize the mutual fund ETF structure. Now they won't do that because they'll lose out on tax revenue, but that is the correct thing. And I'm saying that as an ETF manager, but it is the correct thing probably to do. Now, dividends should also be tax exempt, but here we go. All sorts of other ideas the government won't implement.
Yeah. Well, why do you think dividends should be tax exempt?
Well, they're already taxed multiple times, and that's the reason so buybacks are essentially tax efficient dividends, right? And so the reason that so many companies and investors prefer buybacks is you get to choose. You don't have to sell your stock. And so I think people get that wrong when they're implementing this like 1% excise tax on buybacks. I scratch my head. I say, well, when the company buys the stock, it's already being taxed because someone sold it.
That doesn't fit with the narrative, Meb. They're not really trying to find out the truth of it all.
No, it's just like you've learned over this last cycle, or I've learned, that, in my, like the Dunning-Kruger, when I see things in the investing world that are either just outright false or fake news, I kind of just shake my head and smile because I'm the one that reads a article about something else. It's like, oh yeah, that's interesting. I didn't know that about Afghanistan or uranium or whatever, could be. So anyway, but buybacks is certainly the trigger for me. But I'm long politicians ever getting that ever getting that right.
Yeah. Well, especially in times that are reasonably good. And that's one of the things that makes me nervous about the US generally. It's a macro thought, and I know people don't get paid on macro thoughts, but combine my perception of where we're going with valuations, and I get a little bit nervous.
The valuation argument, the opportunity right now in foreign and emerging, you can find plenty of value strategies in foreign emerging, and just on the dividend side, they're yielding 6%, 7%, P ratios of 5. And in the US, it's actually not that far away either for the value trade, which is pretty astonishing. I think it's like, if I had to say anything about this podcast, it's like anything but market cap weighting, right? Anything but market cap weighting in the US is probably the right place to be. We talked a lot about taxes, and that's probably everyone's going to shut off here. But if you were to do like all the way down, you have like QSBS, ETF that pays no dividends or income, ETF with dividends, direct indexing, maybe depending on how you do it and what happens in the future, and then on down to mutual funds and just kind of separate accounts. How many people are willing to do the top one or two or even aware of them, I think is pretty low. We have a couple funds we're going to file that we wrote a paper. Again, we're going to lose everyone with taxes, but looked at, taxable investor avoiding all income and it being a much better scenario is an interesting sort of idea that, as we talk about reception, we'll see if anyone actually would be interested in, but keep an eye on that for maybe later in the year.
Yeah, well, let me know, because it's one of, so, I talk to people about stocks, right? And fine, stock A is undervalued. I have gotten myself to ask, well, what's the probability it's undervalued relative to all other situations that look somewhat similar to it? And even if it is, when I sell it, I'm going to have to pay tax. Is there another vehicle that I can get into that I can defer that taxable obligation, right? So I don't know, the merit in the ETF structure continues to grow to me the more and more I learn about it. And there's some really fun things about picking businesses, and I don't ever want to give that up, but I'm not sure it needs to be a large portion of my go forward allocation, because I think tax drag is bigger.
So speaking of your allocation, let's do the diagnosis prescription. Bill, what's keeping you from adding the foreign side? Are you or are you starting to wade in, or what?
Yeah, I am.
What's your main objections at this point? Are there any?
No, I don't have any. I need to find the vehicle.
Well, you're talking to the right guy. We got a couple for you. It's funny because, we were chatting with someone in general, and and then we have this old post we actually talked a little bit about in the last podcast, but just going down the main objections, people, they hit a couple that I think are easily disprovable. Cliff actually had a great article that it's a republish in the journal. I'm not journal portfolio. Oh my God, what was the name of it? All these journals have the same names. Journal portfolio. Maybe I got a whole stack of research over here called Journal Portfolio Management, International Diversification. Still not crazy after all these years. But they had an interesting stat that they said the US versus foreign stocks over the past 150 years, you had an element of fundamentals being a driver for the majority of the 20th century, right? Like that was a big part because the US stock and economy went from 15% of world market cap to 60 on the market cap. But over the past 30 years, it's been almost entirely due to multiple expansion, which is because the US went from cheap to expensive and foreign went from expensive to cheap. And that's a really insightful way to look at it, but also really hard because 30 years is an entire career. You and I'll be probably nursing home at that point, my 70s in 30 years from now. And imagine us sitting here 30 years, man, can you believe foreign stocks outperformed the US for 30 years, right? And being able to be in that one sort of regime and being stuck in it. I mean, an example, my mom, God bless her, one of the best investors I know, she'd always talk about, hey, you just buy stocks and you put them away, right? But if you look at the time period she was mainly investing, that was the correct thing to do. But the example we always give is she had GE, right? And so GE in the period she was investing just went straight up. And then, we know what's happened since then. So it's, I think the time horizons are stretched, I think, much longer than people would assume.
Yeah, and the thing I don't love about the single stock game, too, is if you knock it out of the park and, I don't know, you end up with, to your point, a concentrated position, right? And then you really got to be comfortable with finding the next. And it makes sense for some of the portfolio to keep me busy, but I don't think it makes sense for the whole thing. The only thing on the foreign US is, it does seem to me that the multiple has gone up because the fundamentals have improved. I don't know how much more that can go, but who knows? I do think margins in the US are better than margins abroad. Is that a fair statement?
I think they are. The question is how sustainable is that in a world where borders and geographies are becoming increasingly meaningless? The example we gave earlier about who's going to be the next great tech entrepreneur. On my private investing side, last time we were chatting about this, I looked the other day, over half of the angel investments I've done in the past 3 years have been ex-US. And if I actually look at the top 10 on paper, of course, best performing angel investments I've done, the majority, if not the vast majority, are ex-US. And what you're seeing, so the benefit of doing private markets, I was giving a speech in Park City. I said there's about 5 characteristics of private markets that most people don't really consider. They consider the first one always, which is liquidity, right? Liquid, illiquid, there's an illiquidity premium or not. And I used to view this as a negative, right? I don't want to be stuck in this stuff. And the older I get, the more I view it as a positive, right? You are forced to hold something that may grow, may compound a lot, and you're not going to get emotionally selling it. is a caveat, huge caveat, as long as you know what you're getting into. So like the Blackstone REIT stuff, I think that's the opposite side where a lot of people may not have known what they were buying or getting allocated to if you were a client of an advisor and stuck in something for a long extended period. That's not what I'm talking about. Like if you go into it intentionally. Now, a lot of the private equity, angel, venture industry has tried to use this, as many people have discussed, in a nefarious way where they talk about, oh, the volatility of this is 4%, right? Well, of course it's not. It's crazy. But so I'll run through these real quick, and see if I can even remember them. Liquidity being the first one. But number two, and this applies to foreign discussion we were having earlier, but as a quant, this is one of the most important to me, and it exists even more in the private space, is breadth. So the opportunity set of choices is vastly bigger, US versus global, right? The amount of companies outside the US is way bigger than the amount of companies in the US, but the same thing for private companies, even more so. It's like orders of magnitude more choices on the private side. There's only a few thousand investable stocks in the US at this point, and there's thousands and thousands of angel investments every year. The tax treatment is one of the biggest ones in private investing, of course, and the QSBS, and you guys can Google that. We don't need to spend a ton of time on that. But I think it's the most impactful legislation of the past few years as far as entrepreneurs that eventually drives what we're talking about. But more importantly, and I think it'd be fun to see you get into it, because a lot of deep public market investors, I think, are fantastic private market investors, is that it's access you wouldn't necessarily otherwise have. And I don't mean just like, hey, you get access to Sequoia, but it's seeing things that you wouldn't normally otherwise see. And the public markets are so damn depressing. Turn on the CNBC, read, it's just negative news flow all day. Early stage startups, angel investing, it's so optimistic. And you see people changing the world, doing the coolest stuff. And it helps you see around the corner a little bit. So last time on the show, we were talking about some angel things going on. I said, we did a couple of profiles on the podcast talking about space investing in Africa. And those were two areas at the time that had not seen a lot of development as much. And now you're seeing this just massive explosion of companies in both that are wildly successful. And so a lot of these emerging markets are going from sort of 0 to 1. You know, and the old example they used to give is like, hey, it's an industry where it was yellow notepad where people were doing it, or even in Excel, right? And now it's graduating to software, and you're seeing these huge jumps. Long-winded answer of what I'm saying is it helps you look around the corner. So you start to see things a little earlier maybe than everyone else. And so part of this is seeing all these successes these companies are having in emerging markets, Pakistan, Bangladesh, all the way to Latin America. One of my best performing investments is in Venezuela. We'll see if I ever get liquidity on this, but you're seeing this in MENA, in Asia. And so will that percolate through in the next 5 to 10 years as these companies graduate into the public markets and transform their public markets? We'll see. But I think it's possible. And I think certainly, you know, counting on just the US to be the driver is a risky proposition.
Yeah, I agree. All right. Well, I like it, man.
So when you're ready to get on the angel journey, we have an old post called The Journey to 100X. I'll put you in a headlock and take you along with me. But if anything, I think it's additive to the public investing process. You can go full quant, buy a bunch of ETFs, and then just spend your time in this angel investing world.
I'm not that far away. There's a couple guys that I might want to allocate to, and then I mean, you know, it's funny at Berkshire, people were like, what are you doing? What are you going to do? And I mean, I think it's pretty clear, like my skill set is networking and having conversations and whatnot. You know, that can work I think it can work in the public markets, but I think there's a lot of other ways to apply it that I think I'd probably get more enjoyment out of.
This wouldn't work at Berkshire because the answers would be flipped, but I had a fun tweet follow-up the other day where I said, do you think you're a better investor than Warren Buffett? You know, and 80-90% say no, right? They're like, no, I'm not a better investor than Warren Buffett. And then the follow-up was, I said, well, do you own Berkshire stock or replicate his stock picks through 13Fs? And everyone's like, well, no.
Yeah.
This is such a simple... fun emotional bias of like, do you think you're a better investment person? No. Do you invest with them? No, obviously not.
Yeah. I think the only logical answer for that is I think that if I apply the concepts that he has taught to smaller market caps, then he can apply the concepts given how his size, then I can outperform. But that is the only logical answer to what you just said.
Yeah, we had an Omaha ETF filed that we were going to try to launch. The SEC really didn't want us to call it Omaha because they think you're going to be buying stocks in Omaha. And I said, no one's thinking that. What are you talking about? This isn't like Omaha Steaks. Come on, man. Anyway.
Well, they should let you do it, but that is neither here nor there. I did want to ask you, actually, before we got to circle back to something. We got to circle back to two things. Why isn't Russia a zero?
So let me be very specific and say, investors, this isn't talking to our funds. Russia's market got paused, right? So U.S. investor, if of the emerging market funds, I think 95% own Russian securities. And they have now been valued to zero on all of those funds, okay? And most funds, it's an afterthought, like they own maybe a couple percent. Some funds, particularly value funds, some that I know, owned a lot more, maybe 10%. And again, that's a 10% allocation that is valued at zero. Now, the good thing about math is you can't value it at less than zero. And so there's a number of, who knows what's going to happen in the future? Maybe that's zero forever. Russia, as we all know, has a history of people falling out of windows, or maybe there's a coup, or maybe the US and Russia become friends again. Who knows? Hopefully this peacefully resolves and the world carries on its way in love and happiness. But the point being is that there's an opportunity if you invest in emerging markets, which already trade at a PE ratio of 5, these amazing discounts. And listeners, don't believe me. Go to Morningstar, throw in any ticker symbol of an ETF, click on portfolio, and it'll give you an x-ray of the underlying holdings. So super cheap. But embedded within that is essentially a free call option. And there's a handful of funds that had a pretty large exposure that at some point, that may trade, who knows, 20 cents on the dollar, 50 cents on the dollar. You got to remember, these went out at a P ratio of about 4. And on the exchanges where they still trade, some of the Russian stocks trade higher than they were prior to the invasion. And so maybe you get $1, maybe you even get, more if there's a change. You can't count on that. It's not a fundamental number one reason to invest in emerging markets, but given the other 12 reasons to invest, it's an interesting kind of asterisk 13 one that could be a big additive performance boost at some point. Now, I think part of what you've seen in emerging markets the last couple of years has been a shift from people seeing this Russian scenario and saying, oh, wait, Russia is a rounding error. However, China is like half of the market cap of many of these emerging market indexes. And so for our emerging strategy, it's our top 2 positions now are China and Taiwan. So it's a bit of a barbell, but yeah. So
I can see that because a lot of people just view it as completely uninvestable.
Yeah,
but that's kind of embedded in the expectations, right?
That's right.
Or theoretically is. Why don't people like trend?
Trend, kind of like the shareholder yield concept, is one that if you spend enough time with, and it's similar to value. Buffett talks about this. He's like he was inoculated at birth. Trend is a concept that almost every investor understands at their core. I mean, the startup investors understand it probably better than anyone, right? They're buying something. Their stop loss is essentially zero when they lose all their money, or it goes up 100x, 1000x. The market cap investors are actually, oddly enough, and I love to tease my boglehead friends, the biggest trend following investors on the planet. A market cap index, it's fun to quiz friends that are either in finance or not in investing. Hey, you own US stocks? They're like, yeah, I just own like market cap, Vanguard. I own Vanguard. I said, well, do you know how you weight those, how your stocks are weighted? And they said, the biggest ones. And I said, well, biggest by what measure? And they'll be like earnings, or like sales, like revenue, whatever. I said, no, it's just price. It's only a price-based index. So market cap weighting is like the granddaddy of the price-based indices or trend-following strategies. The more the price goes up, the more you own, and the more the price goes down, the less you own. Now, so that having been said, now they won't admit to that. They don't like that. But speaking of a more specific trend allocation, managed futures is the ones that most people kind of talk about. We run some kind of watered down being the wrong word, but most managed futures portfolios, listeners, if you're not familiar with trend, is trying to buy stuff that's going up, short it that's going down. They try to trade 50, 100 markets around the world that are uncorrelated. So nat gas, wheat, Swiss franc, US stocks, on and on. We often will do it long flat because the short side, long short anytime gives you twice as many chances to be right and wrong. Long flat at least tamps down the volatility a little bit, but I think both work. If you look at, and this kind of comes to our flagship strategy, which is called Trinity, which is where I put all my money on the public side. Buy and hold is great. We manage a buy and hold strategy. Problem with buy and hold is the bad times, right? Last year, everything was down 20%. 60-40, one of the worst years ever. Most buy and hold strategies, asset allocation down a bunch. Global financial crisis, same thing, on and on. It all kind of happens when when everything is going south. And so buy and hold is hard because you do nothing for some people. You sit there, right? The old Bogo quote, don't just do something, sit there. Trend often is like the yin yang. It does fantastic during times of crisis, but often underperforms in other times. The past decade versus S&P, right? It's done very poor. It did fantastic last year. Many of these managed futures funds were up 20, 30% last year. But it's hard because you look different. People really don't like to look different in the investing world. It's very uncomfortable when your neighbor's buying a Porsche, renovating their house, and you're not. The two yin yang together, to me, on a behavioral side, is like the perfect combination. And so that's what our kind of Trinity strategies are meant to represent, is these two smashed together 50-50. Now, I think we allocate more to trend than any RIA I know in the country. It's half of our default allocations and half in buy and hold. Now, the interesting part about trend right now, last year you saw it transition in the early part of the year from a very natural resources, short-term bond, sort of risk-off allocation to, by the end of the year, Q4. And, we follow the signals, but I like to cheer. I'm a Nuggets fan. I was cheering for the Nuggets last night. It's hard to not cheer for kind of what you're thinking. And it started picking up foreign stocks. And I was like, oh, no, we're not buying now, are we? Like, this feels like a much bigger, long, protracted bear market. I don't want to be buying now. And so our trend strategy, which is called Global Momentum, has been loading up on global equities and precious metals. And precious metals is interesting. That at least makes sense to me because in a negative yield curve environment, precious metals do fantastic historically. And gold's knocking on all-time highs right now. So we'll see what happens with that. But it's always a head scratcher to me. And I'm curious to see when my sort of subjective views align with the quantitative models. And that strategy right now is almost full boat foreign stocks and a couple sectors and precious metals too.
So it's asset class agnostic, more or less?
Yeah. It targets all the main asset classes of the world, invests in the top third based on momentum. But the kicker for us on the trend side is only if they're above their long-term trend. So investors think of something like a 200-day moving average. So it'll kick it out if it's in a downtrend. So the portfolio can be 100% cash and bonds. It could be 100% in who knows what. But the point, and this is sort of my, if I had to pick a desert island strategy to just survive, if anything's going to go on in the world, to me, this is the one. On a 10-year compounded basis, when we do this in 2030, I would pick emerging markets value right now. But that's super volatile. It could, bounce all around. But trend to me is the most survivable because when there are rare times, usually something's going up. But like in 2008, almost everything was going down. You have these environments where it's kind of hitting the fan. Correlations are going to one. It's rare, but it does happen. And to me, this feels much more in line with that sort of potential outcome.
Interesting. And do you have a value skew on it or anything like that? Is there any overlay?
It can invest in anything,
right?
Yeah. And so
interesting.
Yeah, like I mentioned, like last year it was natural resources, and it's fun if you pull up a chart of this fund.
I didn't know if a portion of it wasn't momentum. I didn't remember if you said that a portion wasn't.
Yeah, so there's GAA, which is our buy and hold fund. There's GMOM, GMOM, which is like its crazy cousins. That's the same general universe, but momentum and trend. And then Trinity is the one in the middle, TRTY, which is like the 50-50 of each roughly. And you can pull them up and watch them sort of zig and zag over time. And we've existed largely in a period in the past 10 years where you've had a few bear markets kind of start, and then it usually rips right back up. It's COVID, fastest ever from all-time high to bear market and back. And then last year we had down, but seems like we're bouncing this year. We haven't really had a 08 or 2000, 2003 or a long bear market sort of exist yet. And so this type of fund, traditionally will really distinguish itself when that happens. So you can, but it's fun. You can kind of watch them zig and zag with the buy and hold version, the idiot's guide to investing, one where it just does nothing. It rebounds once a year and that's it. And then but it's a pretty hard portfolio to beat. It's the tough part.
Interesting. Cool. Well, that's something to look at for me and anyone else that may be interested.
So by the end of this, we turned you into a global investor that is also allocating to trend. Man, this has been a psychology session, Bill. What else can we get you into?
Dude, look, it's part of why I did the pod in the first place, was to figure out where I wanted to be. And I'm still not 100% sure, but yes, I am leaning more and more towards this way of life, at least for a significant portion of my portfolio. Just circling back to the beginning, I want to get to the end. And I used to care a lot about ego, and I used to care a lot about whether or not I'd outperform, and I used to care about a lot of other things. And now I care about my kids looking at me and saying I did a decent job.
Yeah. There was a kind of going back to the asset class agnostic and talking about some things you just mentioned. There's a quote that keeps resonating in my mind. It's that Adam Grant, I think it's Adam Grant, but and I get it backwards because I use it both ways, but he keeps saying, I don't want my ideas to become my identity. And I like it on the opposite. I don't want my identity to become my ideas. And how many people do you know in the investing world say I'm a value investor, I'm a gold bug?
Yeah, that stuff I think is really, really harmful to having an open mind.
Yeah, but it's hard. Easy to say, I think, hard to do. Like it's, I think, particularly, and this goes back to establishing criteria, why we do investments, why we sell, is like you buy something, you become emotionally attached to it, whether you think you do or you don't. And for better or worse, like it's usually causes, behavioral biases that are problematic for all of us.
Yeah, that's right. And I'm not sure that eliminating some behavioral biases from my investable assets is not a good thing. In fact, I think it probably is. So, that's where I'm leaning at this day and time. We'll see. I have no problem flip-flopping, but I don't think I'm going to flop from this. So, all right, man. Well, thanks for joining. I appreciate it. I've absolutely loved your guest list. Great job on the pod. And I appreciate the message that you're out there saying. Not many are saying it.
You have, I think, my favorite voice in all the podcasting space. I'm going to turn you into a Bill like white noise app that I can go to sleep to at night. Your Ted's pretty good too.
That might be a little bit weird for your wife.
Yeah, I know.
Why are you listening to Bill to go to bed?
Yeah,
but I'll say whatever you want, man.
She wakes up in the morning. She's like, I want to go to Omaha. I'd be like, why? What are you talking? Oh, she was sorry. We were listening to Bill last night. It was just he's talking about Omaha.
Oh, that's funny. Well, next time I come out there, we'll have to do it in person, and I can talk to you not on a mic. And
hopefully our office will be done by then. Manhattan Beach, come see us. Should be done in 2 weeks.
All right, I will do. I good luck with the. Do you get a CO in an office or no?
What's a CO?
Like a certificate of occupancy? You get that, or do you just like pass the code?
I hope so.
I don't know. I need it for my house.
We're renters. We're not owners. So I don't know what we need, but hopefully we have it all. We got stuck for like months because our trash can size wasn't big enough or something. Government
Yeah,
sludge.
that makes perfect sense. Perfect sense. Sounds right. All right, man. Have a good one.